The morning news across every major financial network, including Reuters and the Wall Street Journal, has delivered a headline that seems like a miraculous reprieve for the global economy. As the gates of the Strait of Hormuz swing open once again for commercial traffic, the price of WTI crude oil has experienced a staggering collapse of over 9% in a single trading session. For the millions of Americans who have been watching their bank accounts dwindle at the gas pump, this drop to $82.59 per barrel feels like an answered prayer that promises immediate relief for their household budgets. You can almost hear the collective sigh of relief as drivers realize that the crushing weight of energy-driven inflation might finally be lifting from their shoulders after months of geopolitical uncertainty and supply chain fear. However, beneath this veneer of economic salvation lies a sophisticated psychological trap that captures the vast majority of the middle class and prevents them from ever achieving true financial independence. When you see the numbers on the gas station display tick downward for the first time in weeks, your brain experiences a primitive surge of dopamine that signals the danger has passed and that you now have more disposable income to play with. This is the great illusion of modern consumerism because it convinces you that you are wealthier simply because a single variable cost has temporarily decreased in price. In reality, this perceived surplus is often nothing more than a mirage that leads to a phenomenon known as the windfall effect, where people spend their savings much faster than they accumulated them. This brings us to a critical junction in your personal financial journey where the path you choose today will dictate your wealth for the next several years. Why is it that a 10% saving at the gas station so often leads to a much larger financial loss or a deeper debt cycle by the end of the fiscal quarter? We are going to peel back the layers of this market shift to reveal how the most successful investors are looking at this news through a completely different lens than the average consumer. While the crowd celebrates a few extra dollars in their pocket, the elite are calculating how this temporary dip in energy costs will ripple through the broader economy and change the value of every asset you currently own or plan to buy. Understanding the truth behind this price movement is the only way to ensure that you are not one of the millions who will wake up 6 months from now wondering where all that extra money went. We are about to explore the invisible forces that govern your spending habits and why the reopening of a shipping lane in the Middle East is actually a test of your financial character and long-term strategy. The real battle for your future is not being fought in the oil fields or the high seas, but within the neural pathways of your own mind as you decide what to do with the unexpected breath of air you have just been given. What is the actual hidden mechanism that is currently working to siphon that extra cash out of your pocket before you even have a chance to save it? What is truly controlling your wallet in silence while the headlines focus on geopolitical shifts and naval maneuvers in the Middle East? It is not the oil ministers in Tehran or the commodities traders on Wall Street, but rather the complex neurobiology of your own brain's reward system. The Federal Reserve has documented through decades of consumer surveys that when energy costs decline sharply, as we are seeing with this 9% drop in WTI crude, the average American household does not see it as a reduction in fixed expenses, but as a green light for discretionary spending. This is driven by a psychological phenomenon known as mental accounting, where our brains categorize money based on its perceived source or the emotion associated with it. When you save money on a necessity like gasoline, your internal software labels that surplus as a bonus, leading to a surge in dopamine that makes you feel significantly wealthier than you actually are. Research from major American financial institutions such as JP Morgan Chase and Bank of America has frequently shown that for every dollar a consumer saves at the gas pump, a substantial portion is almost immediately redirected toward dining out, entertainment, and other non-essential purchases. This is the windfall effect in action, a cognitive bias that causes us to treat found money with much less care than the money we earn through 60 hours of hard labor each week. By viewing the savings from the reopening of the Strait of Hormuz as a gift rather than a structural advantage, you fall into the trap of selective perception. You celebrate the $30 saved on a full tank of fuel while ignoring the fact that your high-interest credit card debt or your stagnant emergency fund remains a much larger threat to your long-term security than the price of oil ever was. Furthermore, we must address the invisible hole in the system where the broader commercial ecosystem is meticulously designed to capture this newfound liquidity before it can ever reach your savings account. Retailers and digital marketing algorithms are acutely aware of the consumer sentiment index, which often rises in tandem with falling energy prices. When you feel that slight sense of financial relief, you become the primary target for a barrage of advertisements and limited-time offers designed to trigger your impulsive instincts. This is a systemic mechanism where the economy seeks to maintain its equilibrium by moving the capital you saved on fuel directly into the balance sheets of corporations that specialize in lifestyle inflation. You are essentially trading your future financial freedom for the temporary convenience of a slightly more expensive lifestyle, all because a shipping lane in a distant part of the world opened up. It is vital to understand that succumbing to these impulses does not mean you lack willpower. It means you are operating within an environment specifically engineered to exploit your biological survival mechanisms. The relief you feel when seeing a lower price at the gas station is a natural human response, but in the modern financial world, that relief is a commodity that is bought and sold by those who profit from your consumption. The volatility of global energy markets is a macroeconomic reality, but the true crisis is the microeconomic habit of inflating your standard of living to match every temporary dip in expenses. By recognizing that your brain is hardwired to seek immediate gratification, you can begin to build a mental firewall that protects your capital from being siphoned away by the sugar-coated traps of the consumerist machine. As we transition from the psychological origins of your spending habits to the actual mechanics of wealth, we must ask whether this current price drop is a genuine opportunity or just another distraction. While the world focuses on the $82 price tag of a barrel of oil, the real question is how you will utilize the cold, hard logic of mathematics to turn this temporary margin into a permanent advantage. We are about to look past the emotions of the marketplace and examine the specific calculations that separate the people who merely survive economic shifts from those who use them to build lasting legacies. What is the actual mathematical engine that can turn these small savings at the pump into a massive force for your financial future if you choose to master it? Which core mathematical equation will fundamentally alter your financial game as the price of WTI crude oil settles at $82.59 per barrel? Let us look at the numbers through the eyes of a quantitative analyst rather than a casual shopper to understand the immense leverage at play. According to the Bureau of Labor Statistics and historical reports from the Federal Reserve, energy costs represent a significant portion of the average American household budget, and a 9% reduction in fuel costs translates to a tangible increase in net monthly cash flow per million. If the average commuter saves just $100 per month due to the reopening of the Strait of Hormuz, that amount might seem trivial in isolation, but when applied to high-interest debt like credit cards, the mathematical leverage is explosive. By injecting that surplus into a debt with a 24% annual percentage rate, you are effectively generating a guaranteed 24% return on your money, which is a performance level that even the most aggressive hedge funds on Wall Street struggle to achieve consistently. The true magic of this shift becomes apparent when we apply the principles of compound growth as outlined by historical data from Vanguard and the performance of the S&P 500 over the last several decades. If you take that same $100 in monthly fuel savings and invest it into a low-cost index fund with an average annual return of 10%, the mathematical trajectory is life-changing for any long-term investor. Over 20 years, that small adjustment at the gas pump transforms into nearly $75,000 of wealth, and over 30 years, it balloons to over $200,000 as the interest begins to earn interest on itself. This is the difference between seeing money as a medium for immediate consumption and seeing it as a financial seed that has the inherent potential to grow into a vast forest of capital. The reopening of the shipping lanes is not just a news story about cargo ships. It is a recurring deposit into your future if you have the mental discipline to automate the transfer of those savings. We must also consider the secondary mathematical effect of falling oil prices on the broader economy, specifically regarding the consumer price index and the potential for the Federal Reserve to stabilize interest rates. When energy costs decrease, the cost of transporting everything from fresh groceries to consumer electronics also drops, which acts as a powerful brake on the inflationary pressures that have been eroding your purchasing power for the past few years. This creates a rare economic window where your fixed costs are declining while your earning potential remains steady, providing you with a unique opportunity to expand your investment scale without increasing your work hours. The math of wealth is not about making one massive lucky bet, but about optimizing these small margins and ensuring that every dollar you save from a global supply chain correction is immediately put to work in an environment where it can multiply through the force of capital velocity. To understand why reaching a certain scale of capital is so vital, you must look at the mechanics of the wealth threshold, where your assets begin to generate more income than your physical labor ever could. A drop in WTI crude to $82 is a catalyst that allows you to reach this tipping point faster by increasing your savings rate without requiring a painful sacrifice in your current standard of living. Most people fail to realize that the most difficult part of the financial journey is the first $100,000, as the math of compounding requires a base level of fuel to ignite the engine and produce momentum. By capturing the Hormuz ripple and directing it into your investment accounts, you are essentially providing the high-octane fuel needed to accelerate your journey toward that critical mass of wealth, where money becomes an autonomous employee. This is the mechanical reality of the financial world, where those who understand the math are paid by those who do not. And the current market volatility is the perfect laboratory to prove this universal law. As we move from the cold, hard logic of the spreadsheet to the intangible realm of the human spirit, we have to ask ourselves what it truly means to be wealthy in a world of constant geopolitical change. While the math shows us the path to accumulation, it is our internal perspective that determines whether we have the courage to walk it when everyone else is distracted by the noise of the crowd and the latest news cycle. We are about to explore the profound shift in mindset that separates the temporary winner from the permanent master of their financial destiny in the face of fluctuating global markets. What is the fundamental difference in how you define wealth? And how can a single change in your perception turn a simple price drop into a lifetime of true freedom? What is the real difference in thinking about wealth when the world is reacting to a massive 9% drop in the price of crude oil? To understand this, we must look beyond the immediate relief of lower prices and examine the fundamental divergence between an income statement lifestyle and a balance sheet lifestyle. Most people define their financial success by the quantity and quality of things they can acquire with their monthly paycheck, which leads to a reactive existence where their standard of living rises and falls with the cost of energy. However, the truly wealthy and those on the path to financial independence define wealth not by what they can buy, but by the length of time they could survive and maintain their freedom if they stopped working tomorrow. When WTI crude oil prices plummet to $82.59, the average person sees more fuel for their vehicle, while the financial strategist sees more fuel for their freedom machine. This shift in perspective is the ultimate barrier to entry for the top 1% because it requires an individual to consciously ignore the immediate social signals of consumption in favor of the invisible, yet far more powerful, security of accumulating productive assets. The concept of opportunity cost is perhaps the most misunderstood and neglected principle in modern personal finance, especially during times when external economic factors like the reopening of the Strait of Hormuz provide a temporary windfall. When you decide to spend the extra $50 you saved at the pump on a premium meal or a new piece of clothing just because the money is available, you are not simply spending $50 of currency. In the eyes of a financial analyst, you are spending the future value of that capital, which is a much higher price than what is printed on the receipt. If that $50 could have been invested and grown into $500 over the next 2 decades, that single meal effectively cost you $500 of your future self's comfort, safety, and autonomy. The mindset of the elite is built on this relentless and almost instinctive calculation where they weigh every present desire against the massive gravitational weight of their future freedom. It is a radical transition from a scarcity mindset where you grab every scrap of pleasure while prices are low to a strategic mindset where you use low prices as a tactical advantage to widen the gap between your income and your living expenses. Why do decisions that appear impoverished or overly restrictive in the present often lead to the most extravagant and secure lifestyles in the long term? It is because the wealthy deeply understand the compounding power of delayed gratification and the cumulative effect of small, repetitive choices made during periods of economic stability. Choosing to maintain your current budget and lifestyle, even when fuel prices drop significantly, might seem like an unnecessary sacrifice to your peers who are already planning weekend getaways and lifestyle upgrades. However, those who are destined for true financial greatness recognize that these moments of market cooling are the absolute best times to accumulate assets, while the general cost of living is manageable and inflation is temporarily held at bay. You are essentially using the geopolitical stability of the Hormuz Passage to subsidize your own escape from the corporate rat race, turning a global news event into a private economic revolution that takes place within the quiet columns of your own financial ledger. The real difference in thinking about wealth ultimately lies in the mastery of your own internal narrative regarding what you deserve and what you actually need to achieve your highest goals. The prevailing consumerist culture constantly broadcasts the message that you deserve to enjoy the fruits of a cheaper economy and that you should reward yourself for surviving tough times. Conversely, the master of finance knows that he deserves a life that is entirely free from the anxiety of fluctuating energy prices, geopolitical tensions, or market crashes. By shifting your gaze from the temporary, flickering numbers on the gasoline signage to the long-term, steady growth of your net worth, you are breaking the psychological chains that keep the majority of the workforce in a state of perpetual dependency. This mindset shift is not about practicing a life of deprivation or being cheap, but about having a clear and compelling vision of your future that is far more attractive than the fleeting dopamine hit of a new purchase. When you finally understand that your capital is a tool for total liberation rather than just a ticket for temporary consumption, you will never look at a price drop in the global markets the same way again. What exact steps do you need to take the moment you finish watching this video to ensure that the drop in WTI crude to $82.59 becomes a cornerstone of your wealth rather than just a footnote in your spending history? The first and most critical move is the immediate reallocation of your fuel savings toward high-interest liabilities using a strategy known as the debt snowball or the debt avalanche. You must calculate the exact difference between what you were paying for gasoline last month and what you are paying now, and then set up a recurring transfer of that specific amount to your most expensive debt. By doing this, you are effectively turning a geopolitical resolution in the Middle East into a direct attack on the interest charges that have been holding your net worth hostage for years. The second step involves a strategic rotation of your investment focus toward the sectors of the economy that are positioned to thrive as transportation and logistics costs decline. According to data from the Wall Street Journal and major brokerage firms like Fidelity, industries such as commercial aviation and large-scale retail often see a significant expansion in their profit margins when energy prices retreat from their peaks. You should review your current portfolio and consider increasing your exposure to low-cost index funds that track these sectors or established companies with high fuel sensitivity that are now poised for a rebound. This is not about speculative gambling, but about moving your capital into the path of least resistance, where the macroeconomic winds are now blowing in your favor. The third and final step is the complete automation of your savings delta to prevent the psychological trap of lifestyle inflation from reclaiming your newfound margin. You need to log into your primary banking application today and establish an automated rule that sweeps any surplus at the end of the month into a dedicated brokerage account or a high-yield savings vehicle. By removing the element of human choice from the equation, you are protecting your future self from the impulsive urge to spend the fuel savings on temporary comforts. This systematic approach ensures that even as the headlines change and the market fluctuates, your wealth building machine continues to operate with the cold and relentless efficiency of a Swiss watch. It is essential to remember that the window of opportunity provided by the reopening of the Strait of Hormuz may not remain open forever, as global politics are notoriously volatile and unpredictable. Taking these 3 steps immediately allows you to capture the current economic tailwind and convert it into a permanent structural advantage for your household. Most people will wait for a more convenient time to organize their finances, but the truly successful realize that the best time to build a fortress is when the weather is calm and the resources are plentiful. By executing these actions right now, you are separating yourself from the reactive masses and joining the ranks of the strategic elite who treat every market shift as a deliberate invitation to advance their personal freedom. As we prepare to conclude this analysis, we must address the final and most dangerous hurdle that stands between you and your long-term financial security. Even with a perfect plan and automated systems, there is one specific trap that has the power to undo all of your progress and throw you back into the cycle of living paycheck to paycheck. We are about to uncover the mechanism of this final obstacle and provide you with the ultimate defensive strategy to ensure that your journey toward wealth is never interrupted by the siren song of a fluctuating economy. What is the one deceptive trap that could reset your entire progress, and how can you build a psychological armor that makes you completely immune to its effects? The most seductive trap in the entire financial ecosystem is not a sudden market crash or a failed investment, but the insidious phenomenon of lifestyle inflation, which quietly erodes your progress just as you begin to gain ground. As the price of WTI crude drops to $82.59, many individuals will subconsciously decide that they can now afford a more expensive vehicle lease or a more frequent habit of high-end dining. This mental shift effectively neutralizes the entire benefit of the lower energy costs because it permanently increases your baseline cost of living in response to a temporary decrease in a single variable expense. You must realize that the lower numbers on the fuel pump are not an invitation to upgrade your present, but a strategic window to solidify your future before the inevitable return of market volatility. We must return to the image of the Strait of Hormuz, which served as the catalyst for this entire discussion, to understand that the current calm is merely a pause in an ongoing cycle of global instability. Just as we discussed in the opening chapter, the collective sigh of relief at the gas station can quickly turn into a gasp of despair if the geopolitical winds shift and the shipping lanes are once again threatened by conflict or policy changes. If you have used this brief period of lower prices to inflate your lifestyle, you will find yourself twice as vulnerable when oil inevitably climbs back toward $100 per barrel. True financial security is found in the ability to remain indifferent to these fluctuations because you have decoupled your standard of living from the erratic heartbeat of the global energy market. The ultimate lesson from this 9% drop in crude oil is that your wealth is determined far more by your internal behavior and psychological resilience than by the price of any single commodity. While the news cycles will continue to fluctuate between panic and euphoria, your task is to remain the disciplined architect of your own economic fortress by treating every surplus as a mission-critical resource for your independence. Remember that the goal is not to be a passenger on the roller coaster of the global economy, but to be the one who owns the tracks and profits from the ride, regardless of which way the wind blows. By mastering your impulses and applying the mathematical principles we have explored, you are ensuring that the reopening of a distant waterway is the start of your own permanent journey toward total financial freedom and a legacy of stability.